Documentation. Business transactions are recorded on source documents. A source document in a manual accounting system is a paper form, docket, or note which records details of a transaction and provides evidence that a transaction took place. Source documents serve two purposes. One, they form inputs into the accounting system so that the transactions they record can be entered into the first of the accounting records, that is the journals. More on it in chapter 3 and 4. Number two, they assist internal control of the resources of the business, making sure that there is a documentary evidence to support the purchase or sale of items and the receipt and payment of money. That is, it makes it more difficult for people to misappropriate or steal cash or other items. Common source documents used in small businesses include tax invoices, receipts, check butts, ATM receipts, F-Post receipts, and memoranda. Let's go through some of the common examples of source documents that a business uses.
Tax invoices. Tax invoices are issued by the seller to customers. The invoice is the bill for what is owed or charged and is given to the client. Example, hardware store issues tax invoice to customer to charge them for their purchases and keeps a copy for the hardware business's records. Similarly, the hardware store would receive an original tax invoice when it purchases anything, and the seller must keep a copy of the invoice for its own record purposes.
Receipts. Receipts are issued by the business as evidence that money was received from a client. For example, for cash sale, a hardware store gives client a receipt when he or she pays for hammers bought. Now this could also be a tax invoice / receipt. Check butts. Check butts are kept by the business and the check given to the person being paid as evidence that a payment has been made. For example, hardware store keeps check butt and sends check to landlord to pay rent for the shop. ATM receipts. Receipts from the ATM machine as evidence that money was taken from the business bank account. Example, hardware store receives ATM receipt when taking cash from the ATM. F-Post receipts. These are usually received from a supplier when something is purchased from them. Example, hardware store receives F-Post receipt when paying for new hardware products. The supplier will attach a copy of their tax invoice to the F-Post receipt. Let's summarize the source documents which are used to record the transaction for the business. So, cash received by the business. Business will keep a copy of the business's receipt. Original is given to the client. Cash paid by the business. Usually check butts, ATM or F-Post receipts are kept, on the basis of which the transactions are recorded. Business giving credit to client. Copy of business's invoice is kept. Original is given to the client. Business receiving credit from supplier. Supplier's original invoice will be used to record the transaction. A memorandum is used if none of the above is possible. That happens in quite a few situations. See you in the next lessons.